Welcome to the TradeHive Institutional Trendline Playbook. We will cover the essentials of structure, capital, and time in this video. This playbook transitions from a retail structure approach to institutional trend trades. It is built by a trader, run like a desk. The purpose of this playbook is to turn a proven retail system into an institutional trend model. Most traders see trend lines, but few know when to trust them or who is behind the move. The evolution moves from price only to price, plus capital and time. It shifts from guessing to probability alignment, and from short swings to sustained trend exposure. The original trendline strategy, the baseline, uses an action line, safety line, touch points, 4H execution, and manual trade management. The key point is that we are not fixing this system. We are upgrading it. Trend lines work because they represent accepted prices, mark defended territory, and expose trapped participants. The two core setups are the trendline bounce, where price respects the trendline, and the trendline break, where price crosses the trendline, signaling a potential reversal. The problem with most trendline systems is the missing layer. No capital context, no time context, and no confirmation of participation. The solution is to add filters, not indicators. The capital filter uses COT to answer, who is paying for the trend? The rule is to trade in the direction of dominant caught pressure and never fade sustained institutional positioning. The time filter focuses on market cycles, answering, is this structure early, mature, or ending? The cycles include early, expansion, late, and transition phases. Applying cycle rules to trend lines. Bounces are best in expansion and mid-cycle, while breaks are best near late cycle or transition phases. Structure confirmation using BOS or chalk prevents false breaks and confirms regime shifts. The rule is no trendline break without structure confirmation. We use Williams tools for momentum integrity and participation confirmation, avoiding lag-based clutter. These two tools provide essential non-lagging confirmation. Williams %R is a momentum hold tool, not an overbought/oversold or entry trigger. It serves as a momentum integrity check. Pullbacks must hold above -80 in an uptrend and below -20 in a downtrend. Williams accumulation/distribution confirms real buying or selling, not just price movement. For bounces, look for flat or rising AD. For breaks, expansion with a break candle. The full trade checklist requires all conditions to be true. COT aligned, cycle phase valid, trend line with 3 or more touch points, BOS or chalk present, Williams %R holds momentum, and Williams A/D confirms participation. The unified entry logic dictates that the action line defines the entry, the safety line defines the risk, and indicators only confirm the context. Risk and position management means initial risk is defined by the safety line. You only add positions on structure, and stops trail only via the safety line. Crucially, there are no profit targets. The institutional exit logic is to exit when the safety line is violated, the cycle turns, or capital flow stalls. Time frame alignment involves using the weekly chart for bias, the daily chart for structure, and the 4H chart for execution and management. When scaling into trends, focus on the core position and use add-on entries. Remember to pyramid only when you are already in profit. This model avoids chop, false breaks, emotional exits, and overtrading by using systematic filters and rules. You are not trading trend lines. You are trading capital, time, and structure. These are the 3 pillars of the institutional approach. This playbook is for traders who want consistency, size, and longevity in their trading careers.